Quick disclaimer here, trading is very risky and carries a high level of risk. Anything said here is not a financial advice. Make sure you trade with money you can only afford to lose. Stay safe.
Yo, what's going on? What's going on, guys? Good morning here. It's TRADEWITHWORLDBANK here. And in today's video, we're going to be talking about what I asked you guys to drop for me in my WhatsApp questionnaire. I was asking about what do you want me to talk about in my next video, and I noticed that those requests were very, very much. First things first, I try to filter out. Sorry about that. First things first, I try to filter out the most common ones and then the ones I work with a lot. So if you ask me a particular question and then I'm not mentioning it or making use of it or talking about it in this video, that means it's not something I do every day. Those questionnaires, I will only talk about how to um, how to use how to answer your question. Probably if you say how to use a demand and supply, I'm going to show you. But if you're asking me something like how to use Quasimodo entry, I'm not going to tell you because it's not something I use. Okay. Now, someone was asking me about money. Now, yeah, the person said, yeah, what can one do to generate and execute one's big dreams? And I'm like, well, for you to be able to do that, first of all, you should know that it is not trading you first need to do. You have to first look for a work. Then by the time you are working, you should already know about trading. You should have your trading strategy. You should have your trading plan. You should have, your trading rules. Your psychology must be set, even though you are working. Then whatever work you are doing, the money you are going to be making, then you can now use it for deposits and then use it to achieve your dreams. Though it's not something that's going to come easy. Let me tell you this, because the social media has fooled almost everybody to feel like you can achieve all these things in 1 to 2 years. That's a big lie. Social media has fooled people into telling you that whatever you can do in 5 to 10 years, you should be able to do it in 1 to 2 years, which is a big lie. Normally, all these kinds of process requires 5, 10, 15, 20 years, not something that you come and do 1 to 2 years and then you're already successful. No, it is a very it's something that success is something that is not built overnight. It's something that you gather over time. Over time. So if you're asking me what you want to do to achieve your quick dreams, first of all, I'll advise you look for a job. Okay, get a job. Then while you are doing the job, be practicing consistently, strict rules, strict money management, strict risk management, and then you can then deposit from your money and then use it to start trading. Then after that, you can do whatever you want to do. But trust me, it's not something that's going to come easy. Give yourself a span of 20 to 15 to 20 years. Yeah, that is the way it's meant to be. And then second one says how to spot a long time trade. How to spot long term trades. You should know that you are not going to be day trader. Yeah, it should be for the swingers, and yeah, those are swing, not day traders, not scalpers, not you know swingers or position traders. Now, how to spot long time trade? You have to use your 1 week time frame, daily time frame, and 4 hour time frame for your analysis. Okay. Now let's look at BTC for example. Now I spotted a long term trade here on BTC because I'm still expecting BTC to come to 11K. Okay, that's a long term trade prediction. You understand? Because the next support here, this is the resistance. The next support is at what? 11K. The first support over here, which is the demand. Sorry, the first demand is at 19K, which is still holding. You can see now. When market was here, I was projecting a buy at least up to this supply zone. So you can see that that's a long-term trade because this is 1 week, 2 weeks, 3 weeks, 4 weeks, 5, 6, 7. This is 7 weeks at least. So if you got an entry here, you would have held this trade for 7 good weeks. So that's a long-term trade. Okay. So you are going to be spotting long-term trade with your weekly time frame and daily time frame. Most of the time, weekly time frame. Okay, let's go back to this weekly supply zone over here. Looking at this weekly supply zone here, you can see. So this is a weekly, this is a long-term trade, because by the time market will still be somewhere here, maybe here or here, you're already expecting that, okay, market will touch this supply zone, and then the next take profit points will be here. With this, okay, let me use this. With these next points, and you can see now. So from this supply to these TP points, how many weeks now? 1, 2, 3, 4, 5, 6, 6 good weeks. That's 42 days. So it's a long-term trade. So you spot long-term trade with the weekly time frames, and then you can enter with what? Probably the daily, probably the 4 hours or the 1 hour time frame. Because so you should know that your stop loss is not going to be 10 pip stop loss or 5 pip stop loss, like the way day traders always do this thing. So you spot long-term trade with the weekly time frame. So what's the next long-term trade I'm planning now? You can see here, there's a demand here, weekly demand, and look at this now. You can see how many weeks did it hold? 1, 2, 3, 4, 5, 6, 7, 8, 9. 9 weeks. So 9 weeks in profit is a long-term trade also before it goes to what? The supply zone, which was the take profit area. Okay. Now you can see, I believe I'm communicating now. So that's how to spot long-term trade. So now for me, the next long-term trade I'm planning is here, 11K. Okay. So you should be looking forward selling opportunities into this 11K, or wait for it to get to 11K and then start looking forward buying opportunities, and then you hold for a very long time. So that is how to spot long-term trades. I think I'm clear about that now. You look for your, if you are using trend line, breakout and retest, whatever, you use that also for your analysis. But since we are using demand and supply, that's why I'm using demand and supply. So for trend line, you should know that let's do a bit of technicals here. A bit of trend line analysis over here now. If you're using trend line, your next target should be where? This supply zone over here. Sorry, this resistance zone over here. Okay, that's your next zone for a what? Long-term trade, and your TP will be where? On exactly this 11K. Now you can see that the trend line is giving me confluence with this previous resistance turned support. As you can see, nice touch touch on trend line. So you should be looking for a good bounce on BTC from 11K right there. Okay, so if any type of strategy you are using, make sure to spot a long-term trade. All you need is what? The weekly time frame. Okay, and then for me, day trading, I always use what? The 1 hour time frame. You can see this is a big range right now, and I've been managing to take some trades here, though I've not even taken any trades since the beginning of the week. So this is what I'm expecting for BTC. In my mind, I know that I'm still expecting to come to 11K. Okay, so anything I'm looking for, I'll be looking for more shorts than longs. Understand? Now let's move to the second question. The best way to deal with volatility index analysis. And okay, that person is my student, so I'm going to deal with that in our private classes on Sunday. So let's move to the next question. Full explanation about WYCKOFF entry, right? WYCKOFF entry. Yeah, for WYCKOFF entry, I've not really seen WYCKOFF so far these days, but let's take BTC now as the WYCKOFF, BTC USDC. Let's use another chart. Okay, let's use, yeah, BTC it looks like a ranging market. Okay, we are here BTC USDC. Let's use KuCoin. Okay. What's the question again? Okay, WYCKOFF. Then let's assume this is a WYCKOFF movement over here. Let's just assume because it's a range, and then WYCKOFF, in WYCKOFF we deal with ranges. Okay, so let me assume this is a WYCKOFF movement. Now I'm going to talk about this WYCKOFF as a redistribution and then accumulation. Okay, I believe we all know what WYCKOFF distribution accumulation is. So WYCKOFF distribution is, when the market makers are planning to look forward selling entries to drop, to dump a pair, and then accumulation is when the market makers are looking for buying opportunities to pump the pair. And then redistribution is when they have actually dumped the pair, distributed it, and then they want to, dump it again. Okay, something like this. Redistribution. Maybe they're trying to sell off again. You get. So I'm going to start from here, distribution here. I'm going to start from distribution here. I'm going to explain accumulation here. I'm going to explain redistribution at this point. Okay. So let's get started. I'll be talking about the distribution here. Now, WYCKOFF distribution, market makers are trying to sell, okay? And then I've always explained this. I think I made a video on WYCKOFF already. I hope I'm recording. Yeah, I already made a video on WYCKOFF. So on WYCKOFF, what's the first selling point? Let's start from here, okay? That's the preliminary supply. We start from the preliminary supply. That's the PSY. Let me make this one bigger so you can see it well. And this is the climax, okay? So we are assuming that we are taking this trade off a previous POI, right? Probably there's a 4-hour point of interest over there that we're looking to, short from. You understand? Let's assume there's a POI somewhere there, and the market has almost touched the POI. Okay. Now this is the preliminary supply. It means it's the first selling point or selling movement before markets what? Before markets touch the main supply zone, or we can have this here. So you can see this is the first selling movement before it touches it. But this one is very big and obvious. You can use this, but let's use this, okay? So anyone is correct. Then the next one is the climax, okay? That's the what? The buying climax. After the buying climax, we have the, so what is the buying climax? The buying climax is the, um, what does it mean? What does climax mean? Like the highest point of something. So that's the highest point after the preliminary supply. Highest point that is higher than the preliminary supply, and market started dropping from there. So we call the drop automatic rally. This drop like this is called automatic rally. I'm just trying to explain the Wyckoff entry, and then you can see now we've created a resistance, which is going to create liquidity, okay? Because we know that market makers want to sell. So this is we can call this secondary test or the test. Let's call it secondary tests. Let's call it secondary tests. You can also call these secondary tests in phase B, or just you can call it tests. Okay. Now, what are we expecting next? We're expecting market to grab liquidity over here and then give us the UTAD. So the liquidity grab is going to be called the UTAD. Yeah, stuff something like this. And okay, UTAD, and then the entry is going to be where? On the supply zone that was formed before liquidity grab. Okay, so this is the break of structure caused by this liquidity grab, UTAD. So this is the supply zone, right? So the entry will be over here. That is where the entry is going to be somewhere here, you can see. So that is Wyckoff entry. That is Wyckoff entry. You enter after the liquidity grab, and then after you've seen these properties showing you that okay, this market is in a distribution phase and then it actually wants to sell. Okay. So since this one didn't mitigate, you can use this supply zone. I don't think that also mitigated. But now let's move to this point again. So you should be only trading Wyckoff when, though you can trade Wyckoff when it's not touching any point of interest like this, but it's always very advisable to trade Wyckoff when it is at a supply zone or at a demand zone, to give you confluence. You understand? I believe everybody knows what confluence means. So you can get that confluence plus the Wyckoff, supply zone plus Wyckoff plus another supply zone. Then it's actually still very nice. Unlike trading Wyckoff, something like this, you want to take a buy and then you're just trading Wyckoff. It might be a redistribution. Okay, it might be a redistribution. So what is the redistribution? Redistribution is when you want to sell again. So what are the properties you want to see? You want to see the same thing that happened here, and then you want to see what a UTAD. Okay, so You want to see a UTAD. What is the UTAD? Liquidity grab. Okay. The liquidity grab after this old resistance. After this resistance has been created here, you want to see a liquidity grab. Liquidity grab, something like this, a break of structure, and then your entry is going to be after the liquidity grab. Okay. So I think I've explained that. So you give it the real labeling it needs. Don't mind my labeling, but you get the idea now. So for the buy also, let's assume this is on a demand zone because we want to be trading off demand and supplies for more confluence and confirmation. Let's see if there's actually a demand zone over there. Yeah, so let's assume that's the demand zone we want to be buying from. For distribution, for distribution, so it's still the same thing. What do we have here? That's the preliminary supports. Remember, the first one was preliminary supply. Now the second one is preliminary support. Okay, that's the first move to the upside before the what? Before the selling climax. So over here we have the selling climax because that's the selling point that was lower than the preliminary support. And then the move up is called what? The automatic rally. Automatic rally is always after the climax. Okay, and then we have the tests or secondary tests. You can also call this the test again. You can call this the tests. Then what is happening here right now? So the resistance is formed. You are waiting for what? Liquidity grab, which is going to be the spring. Okay, there's going to be the spring somewhere here. It's going to be the spring, and after the spring, you wait for the liquidity grab, break of structure, and then this will be your entry. Okay, this will be your entry. This will be the next supply zone. So might be the same thing over here again. While the market is approaching, it might do stuff like this and then drop. Okay, that is also WYCKOFF. You understand? So that is just the idea about WYCKOFF and how we came about WYCKOFF. Okay, so that is the entry I'm expecting here. But for me, I'm not taking that as a demand zone. Yeah. Then the next question is question relating to psychology behind a consistent trader. See, the first thing that won't mess up your psychology is having a trading plan. There's no how I won't say this is the last question, right? Because I only took out 5 questions. Oh, somebody said COCH. I'm just saying that actually. Let's move to dollar index. Yeah. So someone will say what's COCH? Someone will say what's the difference between COCH and then BOS? So now look at change of character over here. This is change of character. Why is it change of character and not a break of structure? Now you can notice this aggressive uptrend, right? You can notice this aggressive uptrend, higher lows, higher highs, higher lows, higher highs, higher lows, higher highs, higher lows, higher highs, higher low. And then it should be expressing what's a higher high, if I'm correct, right? But now what happened? There was a breakout of this low. It should give us higher low, higher highs, higher high, and then continue. But what happened? There's a first breakout of this low, which we know as what break of structure. But because it's the first breakout and it's the first um, break of structure after this massive uptrend. That is why it is called change of character. It means it is that change or it is that break that caused this uptrend to turn towards a downtrend. That is why it is called a change of character. So it is that break that is happening first that is signifying that it is trying to change the trend from an uptrend to a downtrend. And then consequently or subsequently we can then have break of structures, break of structures, break of structures. But first things first, it is what is called a change of character because it's the first change or the first break of structure signifying that no, this trend is about to what move from an uptrend to a downtrend. And then it's mitigated the change of character, which is the supply zone, before the break of structure, before the change of character, it sold, and then it broke another structure, it broke another low again. So now we have a change of character, and then we have what? A break of structure. That is signifying that the sellers are now in power. Okay, sellers are now in power. You can use this supply zone here, and then at least we should know that it should what? Sell to this demand level before going up again. Looking at the weekly time frame, just mitigated this weekly demand. So I still expect more bullishness. You can see how it is flying. But let's follow the structure we have on the 1 hour time frame. So this is the first break of structure before after the whole overall uptrend. That's why it's called a change of character. That's why it's called a change of character. So I think I've explained the meaning of break of structure now and change of character. So that is the difference. Change of character is the first break of structure, and break of structure is the second break of structure. So, but nonetheless, you can still call this break of structure. You can see now. So if I call this break of structure, what has happened? Nothing has actually happened, right? It's still I still have the same, overall setup. You understand? But it's just always right to say change of character, because that is the first break of structure, and then that is the break of structure that caused the shift from this uptrend to what this small downtrend. That's why it's called change of character. Then yeah, the last question is which I'll be talking about. So there was a lot of questions, but like I said, if your question wasn't answered, then it means it's not something I deal with. Okay. Then psychology behind consistency, and then advice from giving back profit to making profit and keeping it. So I'll first talk about idea behind consistency. First things first, you need to know what you are doing. You need to know what you are doing. Secondly, you need to have a trading plan. So a trading plan is what will guide you. I always say this, but most people feel like trading plan is not necessary, you don't need it, this and that. What is your trading plan? Trading plan is what will tell you when to buy and when to sell, not actually your strategy. Your strategy can tell you buy at a million times. For example, let's look at the Asian session now. Okay, let's look at UPUSD 15 minutes time frame yesterday during the Asian session. Was it yesterday now? Which pair is it, safe? Okay, there was one pair that moved during the Asian session, and then I want to show you guys something about trading plan. Yeah, but let me just take that away. I think I can't see it now. Now, trading plan is what will tell you that buy and sell. Why? Because many a times your strategy will always give you buying and selling opportunities. Is that not a supply zone? Yes, that is a supply zone. I should have taken a sell, right? Is this not a supply zone? Yes, it's a supply zone. I should have taken a sell, right? There's a lot of times whereby your strategy will tell you buy now, sell now. Okay, this is a demand zone, right? Yeah, I'm trading demand and supply. My strategy has told me what to buy. Okay, this is what I'm looking for. This is what I'm looking for. Now, my strategy told me to buy, but my trading plan didn't tell me to buy. So what was in my trading plan that didn't allow me to buy? My trading plan says I shouldn't trade during the midnights. As simple as that. And then while everything is happening, demand is mitigating, blah blah blah, I'm out of the market. Even though it's giving me a nice setup, it is what? It is a no trading zone. Because why? It's happening during midnight Asian session where the spread is wide. And then you can see what happened, came down a little bit, and then in fact it did well. You understand? So a trading plan is what will tell you, okay, buy now, sell now. And then failure to comply strictly to your trading plan, you should know that you are not deceiving anybody, but you are deceiving yourself. Because take a look at this nice setup, but I've broken my trading plan, and then when next I see a setup during the Asian session, what will happen? Definitely I'm going to take the trade, because I'm like, since I didn't follow my trading plan that day, it went, and then I shouldn't follow my trading plan for midnight. Let me just continue taking every midnight trade, and then every midnight trade you are now getting fucked up. You are now getting fucked up, and then you are like, wow. So that is the way it is. Now somewhere over here, I also missed the buy here, because I didn't get a smaller time frame entry, you understand? But it was a nice trade, okay? And I didn't want to use aggressive entry here. I didn't want to use aggressive entry, but you can see it was a nice trade. So trading plan is what will tell you, okay, so how do you build your trading plan? First things first, you need to have a strategy, which everybody has. Then you need to know the way it works. Is your strategy helping you during Asian session? Is your strategy helping you during London session? Is your strategy helping you during New York session? You want to know all these things. You want to know the time your strategy works most. You understand? Then you already know that, okay, my strategy helps me most of the time during New York session. Okay, so during New York session, that is when you want to trade, not seeing a setup and then you want to trade Asian session. No. Then after that, your strategy should also give you, you should know your win rate, right? Your win rate and your risk to reward. You should know all those. And then next thing is you should about the strategy. I forgot now. I've forgotten now, but your entry and exit plan. What is your entry and exit plan? Is it a nice entry plan? Is it a nice exit plan? Is it a good strategy that allows you to take 1 to 1 or 1 to 5 or 1 to 10? If you know, okay, your strategy is giving you 1 to 1 every time, then you shouldn't be looking for 1 to 10 when you start trading. You get the concept now. 1 to 1, you stick to 1 to 1. If it is 1 to 10, then you stick to 1 to 10. But if your strategy is giving you 1 to 5, don't be looking for 1 to 10. That's some psychology behind some things now, because you are now fucked up when you start trading and then you are saying 1 to 5, but you are so greedy that you want 1 to 10 and it gives you 1 to 5, but it reverses. You understand? So you should have those patterns. And then secondly, you should have a journal also. Okay, how did I take this trade? I took a buy here, or I took a sell here. You know, you should write it down. And then your losses, when you are writing everything down, your losses will have a pattern. Probably you are losing because of spread, you are losing because of spread, you are losing because of spread every time. You already know you're losing pattern. You understand? Because when you take almost 100 trades, you can't remember all the 100 trades you took, actually. So, but when you are trading a trading journal, when you are using a trading journal, and then when it's weekend, probably like Saturday, and you are reading through, and you're looking at your losing pattern, you already know what is causing the loss. And then when you're looking at your winning patterns, you're already looking at what is causing you to win most trades. So you stick to that. And then you're losing pattern. What do? You adjust it. Probably if it's because of the spread, then you know that next time you increase your what? Stop loss. Increase your stop loss with the spread. Okay. Now, also going back to trading plan, you must have done various backtests with the strategy before formulating a trading plan, because you should know how the pair moves. You should know the time the pair moves. You should know the economic indicator affecting the pair. You should know how the pair reacts to news. All those kind of backtests, you should have it in your hand, so that whenever you are trading and you've done enough backtests and you are seeing similar kind of setup, you already know what is going to happen. At least at the back of your mind, your psychology is telling you that, okay, I've seen this kind of setup before and I know how to handle this kind of trades or trade. I believe I'm communicating now. So these things are very, very important. Know your winning risk to reward. Make sure you already know the New York session, these sessions for trading. Make sure you've consistently backtested more than 100 trades, not just backtesting 5 days ago and then you are done. No, a lot of backtests. Okay, and I'll move to the next question now. So I've talked about psychology a little bit, because psychology, on the other hand, when you don't have a trading plan and you're just coming, you're just seeing different zones, you're taking trades from different zones, you actually get fed up at the long run, actually, at the long run, because you don't have a trading plan. You don't have something you are following, that, okay, this is what I want to see before I click buy on MC4. Just because buy and sell buttons are easily to press now on MC4 doesn't mean you should press it on every trade you see. You understand? So that is the way it is. You should have a reason and a backup for, why am I taking this trade? I'm taking trade because of this. You should be happy when you take a loss and the loss is according to your trading plan, then you are fine. Unlike when you are taking a loss and you don't even know the reason for the loss. I'll be moving to the last question. We are 29 minutes up already. I'll be moving to the last question, which says advice from struggling and giving back profit and making profit and keeping it. Yeah, this one has to do with the growing of accounts. Growing of accounts, you should know your pattern of growing accounts. There are some people that when they deposit probably $10 and they take it to $50, they 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 lose it back to $10. And then when they take it back to $50 again, they keep continuing that cycle like that. So if you've known the type of trader you are, okay, you're the type of trader that deposits and loses it, deposits and loses it, then when next you want to trade, you already know your losing pattern, right? When next you make $50, what do? You withdraw 40, it remains 10. Still reasonable like that, okay? And then once it remains 10, what do again? You continue your trading back. So this type of trader, what kind of trader is this kind of trader? It means you are not um consistent with your lot size. It means whenever you are growing a small account and it has turned probably to a big account, most of the time you go greedy, because there's nothing wrong with changing lot size, because whenever you are growing a $10 account or a $50 account, you want to change lot size. But some people are always very greedy with the lot size thing. They're like, okay, I've done 10 to 50, then I should be able to do 50 to 100, then they double the lot size or they even triple the lot size. Most of the time, that is always what is happening with all these kind of traders. That is all. Most of the time, that is always what's happening. They are very comfortable and they add greed to it too. You get. But if you know there is this type of trader, $10 to $50, you've grown it. Okay, withdraw it. It means you are very protective when you are trading $10. But when the account grows, you are overconfident, and then you then try to increase the lot size. There's nothing bad in increasing lot size, but you are greedy with it. You get. Now, another thing is most of the time some people say they hit stop loss and they are always it always goes in their direction. If you are still in this category, it means you've not done enough consistent back tests. Yes, you've not done enough consistent back tests to still be complaining that a trade will hit your stop loss and move in your direction. If a trade hit my stop loss today and then moves in my direction, probably a sell like this, yeah, and move in my direction, I know that definitely if it sells, then I should be able to catch this buy, and then it shouldn't hit my stop loss and move in my direction again, because I already know that, okay, probably it hit my stop loss because maybe it just spiked. You understand? So all these things are actually normal. But if it's still something you are complaining about, it means you've not done enough back tests. Because for me now, if I've done enough back tests, I know that, okay, whenever I take a buy here, I should not have the same problem again. You understand? But some people now, if they have that kind of problem, what do they do next? They increase their stop loss, and then market will still come back to hit that same stop loss again. Where's my arrow now? Markets would come to hit that stop loss again, and they still move in their direction. Now you can see where the problem is. They are increasing stop loss, but still the same problem. But if you've done enough back test with this pair, now for me now, look at gold. Okay, I even thought I was on gold. Look at gold now. There's a lot of times I always trade with 5 pips SL over here, and then you can see here 7.5 pips SL. That's 5. That's 7 pips SL. Now I think I also took a buy somewhere here some weeks ago. Yeah, this buy here, then this buy here. Now, if I don't mean I took a buy here now, and probably it's this week took me out, okay, I'm still fine because I know that, okay, I followed my trading plan, I followed my stop loss plan, but one way or the other, market will kick you out. Fine. I know that if I'm entering again, I should still follow my same rules, not then increasing the stop loss to something like this. If it will still hit your stop loss with 2 pips, it will still come and hit your stop loss with 200 pips or 20 pips rather. So you can see now it was on 7.5 pips SL. That doesn't allow me to increase my stop loss now. But if you are still inside this cycle, it means you haven't done enough back tests. You've not gotten the hang of your pair. Now look at USDJPY. Most of the time USDJPY, I give it enough SL. Why? Because it always spikes a lot when it gets to a point of interest. You can see it's got to this 1 hour point of interest. Look at that spike. I didn't mean I was taking a sell here now and then my stop loss was somewhere here. You can see now. Let's just assume it was like that. But because I already know my pair, I already know that USDJPY, it always spikes at point of interest. I know. Then if I'm taking my 1 minute time frame, what do? I'm always extra careful. I'll be extra careful that, okay, since I know that to spike on this point of interest, my stop loss should be somewhere here or somewhere here or somewhere here. You should be logical with these things. Not then you know that the pair will take you out at the point of interest, and then your stop loss is still there. It means you don't know about the pair yet. You understand? You should know how this pair works. You should know their reactions at regular point of interest when you want to take a buy or when you want to take a sell. You should know how they react. Look at GU now. It didn't even get there before it spiked up. And I was even waiting for it to come here and then take a buy. It didn't even wait for me at all. But nice, it's nice that some people caught this buy. You can see now. So now, why didn't I catch this buy and some people caught this buy? We are trading the same thing, but still, we don't have the same trading plan. You understand? Some people's trading plan might be this fair value gap over here, and that's, and then their entry will be here, right? Is that not a good fair value gap? And then their stop loss will be below the fair value gap, like this 7 pips SL, and their CP will be wherever it wants to be, right? This is a fair value gap, right? Trading off imbalance and the likes. Yeah, I know about the strategy, but I really don't use it because most of the time it still points down to demand and supply. Okay, looking at this fair value gap, look at where the stop loss is. It's still on my demand zone. Okay, so that's why I always feel like fair value gap is actually good, but when you look at it, sometimes it might just spike into your demand zone and then give you your entry and then you move. So that is why, you understand. But still, this is what I'm still trying to say. When you see other traders trading and everything is going their direction and you want to follow them, you can't follow them because you don't know since when they've been trading that particular thing you are seeing them doing. Okay, they have been trading for a very long time. They've practiced it, they've mastered it. For me now, trading volatility 75 index, you can see most of people see my WhatsApp status and they're like, we are 75 index, you are this, you are that, this and that. We are 75 index and volatility index rather. I've been trading it. I'm using the same thing over and over again, over and over again, over and over again. It's not like I'm copying someone else's trading plan. You understand? I'm following my rules. If I hit my stop loss, I'm fine. If I hit my take profits, boom. That is just it. So that's just a little bit tip of psychology behind it. Don't follow. You don't need to follow what everybody is doing. If you are still following what everybody is doing, looking for strategy, looking for the best, then it means you still don't know what you are doing yet. Okay, it's not bad to get a course. Okay, for example, now let me talk about getting a course. But when you are getting a course because probably the person selling the course has a car or just bought a car, then you should know that something is wrong somewhere. But if you are just getting a course because you want to know how maybe fair value gap works, stuff like that, then it's still very fine because you just want to add a little bit to your knowledge. You understand? But when you are getting a course because you are saying that this person made $1 million today, let me go and buy his course, then you should know that there is something wrong somewhere. Yeah, that will be all for now. Peace, guys. I'm out.